is there going to be an area where okay. Good afternoon, everybody. Thank you very much for joining our webinar on Social Security today. I've got 101. I will give it just a couple more minutes for a few more people to join, and then we'll go ahead and kick it off. All right, we've got 105 on the clock. Thank you, everybody, for joining our call to our webinar today on maximizing Social Security and navigating Medicare. We want to thank the Greater Alliance for giving us the opportunity to spend some time with you all today. Throughout the course of our day, we work with our clients to develop comprehensive financial plans. And a big part of that financial plan, or a common question, is how do I optimize Social Security? And can you tell me a little bit about Medicare, as that may be a new space for people as they begin to enter those years of retirement? So today we brought on the call with us, Laird Johnson. Laird is the Senior Director of the Advanced Market Group at Equitable, one of our partners that we do a lot of business with. So we wanted to bring Laird to you guys to speak a little bit about Social Security and Medicare. So I am going to flip it over to you, Laird.
Thanks, and welcome everybody, and really do appreciate you taking some time out of your day to join us on what I think are going to be two really important topics, and probably two of the more commonly taught topics that we in our advanced markets group really discuss in working with financial professionals and their clients, which is Social Security and Medicare. I'll be the first to admit I enjoy talking about Social Security more because I think it shows we talk about strategies to maximize or to get the most out of your Social Security benefit that you can. Unfortunately, when we start talking about Medicare, we're going to probably talk about, I think one of the areas that from an expense perspective, people really need to get their arms around, because it probably is one of the, more impactful expenses for people, as they retire. So one of the main reasons why we talk about Social Security planning, and we hear this a lot, conversations I've had with my parents as well as clients that I've had the chance to work with, is most people just figure at some age you start collecting Social Security, and there's not that many variables that go into the decision. And I think what you'll find as you get more educated around Social Security, there are some definitive strategies that can really help you maximize the amount of income that you're going to get out of Social Security. So we'll talk about those strategies today. as well as kind of an overview of the system. But one of the main reasons why we think this is such an important topic and probably our most widely taught seminar, I think, comes from the information we get from Social Security themselves. So Social Security did a study a few years ago where they looked at the over 60 million individuals in this country that were collecting some sort of Social Security retirement benefit, whether that was a benefit based off of their work history, their spouse's work history, or a spouse that may have predeceased them. And what they found was that 74% of those people receiving a Social Security benefit were receiving what Social Security likes to call is a reduced benefit, meaning that that individual made a decision to start collecting their Social Security benefit before the age at which they would get 100% of their calculated benefit. So when I hear numbers like that, 74%, which, math works out to be about 3 or 4 individuals, it seems to me that a lot of individuals are making a decision to collect early. And I think if they really ran the numbers and understood the mathematics of Social Security, they might make a different decision. And I wish I could tell you that there was one Social Security decision that's going to fit everybody who's on this call or everybody who is out there. And unfortunately, it's going to be unique to each individual situation. So I think the most important thing, you take one thing out of our time here today, and that would be how important it is to meet with a financial professional that can help you develop a comprehensive retirement income plan. Because Social Security, albeit a very important piece, is just going to be the one piece of your income planning strategy as you get to retirement. Let's talk a little bit about the value of Social Security. As I mentioned before, as of 2016, so this number has obviously gone up. There's over 61 million Americans who are receiving more than $870 billion in Social Security benefits in a given year. Social Security is what's often referred to as the #1 federal entitlement program. In fact, it is the single largest line item on the federal budget. If you look at the 65 and older population, which is really the key Social Security demographic, 90% of those individuals, 65 or older, are receiving some sort of Social Security benefit, whether that's a benefit based off of their life, their spouse's work history, or a deceased spouse's work history. And the value proposition for Social Security, I think, is a really important one. One, it provides you income that you can't outlive. Once you start collecting your Social Security benefit, you're going to collect that check on a monthly basis for as long as you live. Number 2 is it provides you with inflation-adjusted income. Every October, there's a CPI index that will come out that provides for what I'll call the inflation hedge, or the increase year over year for your Social Security benefit. So as CPI or inflation goes up, so will your Social Security benefit. And it also provides survivorship benefits, that if something were to happen to you, it could provide benefits not only to your spouse, but even in certain circumstances to your children as well. When you look at Social Security benefits, there's really 3 different types of benefits that could impact somebody's Social Security retirement, and then all 3 of them may impact the individuals. The first core one is your own retirement benefit. So it's based off of your individual work history. Essentially, Social Security is going to calculate how much payroll taxes you pay into the system, will basically determine a retirement benefit that you're eligible to collect once you get to retirement. They're going to look at your highest 35 years of earnings, and what they'll do is they'll basically index your earnings on a monthly basis as well as index them for inflation. And what it does is it provides you a full benefit at full retirement age. Full retirement age is a very important topic because that is the age at which you are entitled to 100% of your Social Security benefit. So that provides us with the foundation of how your own personal retirement benefit is calculated. Another very important benefit is what's called the spousal benefit, that Social Security recognizes that in many married situations, you might have one spouse who has worked every year from when they finished school until they retired, and then there's going to be other spouses that have a more limited work history, and therefore their Social Security benefit is also going to be limited because they don't have as many years of paying into the system. The way the spousal benefit works is that if you're part of a married couple, you both file for your own benefit. If the spouse with the lower benefit, if that benefit is less than half of what their spouse's benefit is, they are entitled to what's called a spousal benefit. They file for their own benefit first, and then Social Security will pay them an additional benefit, which will bring their combined benefit to be exactly 50% of their spouse's benefit. And that this benefit, which is probably one of the more eye-opening things for individuals, are also available to divorced couples. Probably the area of Social Security planning that we see offered, I guess, benefits that people didn't even think were possible, was that Social Security is pretty lenient in extending benefits typically available to a spouse as well as to an ex-spouse. And I'll kind of go through what the requirements are, in a bit, but obviously an area of this that I think does provide some significant impacts to individuals. And then finally, what I think is actually the most important benefit as we talk about Social Security, and that's the survivor benefit. This is the benefit that's available to a surviving spouse. The basic way it works is that if your spouse predeceases you and their Social Security benefit is larger than yours, upon their death, if you are full retirement age, you are entitled to receive 100% of their Social Security benefit instead of your own. So it gives you the opportunity to increase your benefit if a spouse predeceases you who had a larger benefit. And just like with the spousal benefit, may also be available to divorced spouses depending on the situation. So all three of these benefits, I think, really kind of meld together to give us, the pieces of the puzzle for the Social Security puzzle. And it's how we piece these together that becomes a very important in the planning process. Let's real quickly talk a little bit about how Social Security works. You'll see on the screen here is a copy of somebody's Social Security statement. You can access your statement from the Social Security website. You'll see that up on the screen, www.ssa.gov. You register on the site and you can access a PDF version of your statement really almost at any point in time. So a couple things what the statement is going to show is actually on the back of the statement, it provides you with your earnings record. So it's basically going to show the years that you have worked and what your taxed earnings are for both Social Security and Medicare. And as I mentioned previously, what Social Security is going to do is they're going to look at your best 35 years in an effort to determine what your Social Security benefit would be. So what you'll see on the front side of the statement is Social Security provides you an estimation of your benefit. So for myself, I'm 48 years old. I could basically look at my Social Security statement and it would basically look at my work history up to this point. It would assume that I would have a similar work history all the way till retirement. And then it provides an estimation of what my Social Security benefit on a monthly basis would be based on those calculations. So what you'll see here is it shows you three different numbers. The first number is, what would your Social Security benefit be if you wait to your full retirement age? So you'll see here that's $1,554 per month. It will also tell you if you were willing to wait to the age of 70, Social Security will give you what are called delayed retirement credits, which would increase my benefit to $1,900 per month. And then it also shows me if I was to collect on essentially the first day that I'm available, which would be I'd be 62 in 1 month, it shows that the benefit here would be $1,072 per month. And in essence, that's the Social Security decision. What do I want? $1,000 a month starting at age 62? Do I want $1,500 a month starting at age 66? Or do I want $1,900 a month starting at age 70? And that's the trade-off, the cost benefit that people need to evaluate moving forward. So here's kind of a quick example on how your full retirement age will work. So what you'll notice here is there's 3 ages, really 2, I think that are going to be most impactful to people as they approach Social Security age. If you were born 1937 or earlier, your full retirement age was 65. If you were born between the years of 1943 and 1954, your full retirement age would be 66. And if you're born the years 1960 and later, you'll see your full retirement age is 67. Now, what you'll notice is here in 2020, we are actually in the last year of that 1943 to 1954 age range of people turning 66, right? 1954 plus 66 brings us to 2020, which means that people born in 1955 are the next wave of people to basically reach the age of 66. You will notice here, those people, their full retirement age would actually be 66 and 2 months. Because they're born between the years of 1954 and 1960 moving forward. But this is a really important age in determining what benefit you are going to receive. And the simple analysis is that if you collect between the ages of 62 and your full retirement age, your benefit is going to be reduced depending on what year you actually collect for the first time. And if you're willing to wait between the ages of 66 and 70, you get those delayed retirement credits, which is an 8% simple interest credit on an annual basis to your benefit amount, all the way up to the age of 70. One thing that's important here is that past the age of 70, there is no financial incentive to wait past that day. So that would be the latest age you would want to wait to take your benefits. Here's, I think, a better example of showing you what the reduction could potentially look like. So what you'll see, as I mentioned before, it's a 25% reduction if you collected right at 62 in 1 month. But if you waited to 63, the reduction becomes a 20% reduction, or you're getting 80% of your benefits. So obviously, the closer you get to your full retirement age, the less the reduction is going to be. But understand that this reduction is permanent and will essentially be applied to your benefits for the rest of your life. As I mentioned before, you have these delayed retirement credits if you're willing to wait past the age or the full retirement age. And you'll see here it's just a simple 8% credit each year moving forward. The interesting stat is that less than 1% of all Social Security beneficiaries actually collect these delayed retirement credits, but it could provide you with some significant income in retirement. And as I mentioned before, here's how the spousal benefits would work. If you're willing to wait till your full retirement age, it's going to be calculated at 50% of what your spouse's benefit would be. As I mentioned, you take your benefit first, and then there will be an incremental benefit that will bring up your total benefit to the amount of 50%. You will notice that if you collect a spousal benefit before you reach your full retirement age, you're going to see the same type of reduction on those benefits moving forward. And as I mentioned before, the survivor benefit is when one spouse predeceases the other. You know, a couple requirements on the survivor benefit. One, you need to be at least 60 to collect it. And you need to be married for at least 9 months prior to your spouse's death. But Social Security is going to apply the same logic here in that they're going to look at the age of that surviving spouse when he or she starts collecting this survivor benefit. If they're full retirement age or older, they get 100% of the benefit. If they're younger than their full retirement age and obviously older than 60, they would see a reduction on that benefit. As I mentioned before, one of the areas that we see a lot of planning and probably a lot of eye-opening experiences is in the case of divorce. I think most people figured, hey, if I'm no longer married to my spouse, I shouldn't be able to collect a spousal benefit or even a survivor benefit. But in many cases, you actually still can. The key in both scenarios, probably the most important key, is you needed to be married to your ex-spouse for at least 10 plus years. If you were married to your ex-spouse for at least 10 years, you're currently unmarried when you're filing for the benefit, and you meet the age requirement, you would be entitled to the same exact benefits as a spouse would be, moving forward. So for a lot of individuals, this may open up a source of income that they previously didn't know even existed. So a couple other factors I think to keep in mind when you're making the decision around Social Security. And one of them is life expectancy, right? So if you think about Social Security, the longer you live, the more value you will get out of waiting to take Social Security. So when we start talking about life expectancy, for example, if you were a male age 65 today, you have a 50% chance of living to the age of 87. So that's your average life expectancy. A little bit longer for a female. And if you look at it from a couple's perspective, there's at least a 50% chance that one of you lives to the age of 93. What Social Security will tell you on their website is that if you went to look at just a simple break-even calculator and you just compared dollars in, dollars out, at what age do you break even between taking it at, say, at 62 versus taking it at 66, they will tell you it's somewhere between the ages of 79 and 80. So when you start talking about average life expectancies for a single individual being in their late 80s, on average, you would get more money out of Social Security by waiting than you would by taking it right away. Yet, as I mentioned in the opening, one of the challenges is what the stats tell us is that almost 75% of people are collecting Social Security before their full retirement age and are thus collecting a reduced benefit moving forward. Now, another factor that comes in for some individuals is what happens if I'm still working, but I'm also collecting Social Security. So maybe I'm working part-time. I've started working, a part-time job instead of my full-time career. And what Social Security will tell you is as long as you're at full retirement age or older, if you have earned income, it has no impact on your Social Security benefit. But if you make the decision to collect Social Security early, meaning you're starting your benefits somewhere between the ages, let's say, of 62 and 66, there is going to be an impact on your from your earned income on your Social Security benefit. So if you look at the column where it says under FRA, which is your full retirement age, you'll see that the earnings limit for a given year or for 2020 is $18,240, pretty low income level. What happens is once you hit that earnings limit of $18,240, for every $2 of additional earnings that you have in that calendar year, you're basically going to have to give back or have withheld $1 of Social Security benefits. So a real simple example is if somebody age 63, let's say they make $28,240 in a given year, they're $10,000 over their limit, they would technically owe Social Security $5,000. What Social Security is going to do starting that following year is they're going to withhold that Social Security check on a monthly basis until that $5,000 is repaid. Now, this is not a penalty in the fact that Social Security keeps this money. In fact, when you reach your full retirement age, they would factor these withheld benefits back into your Social Security check. It is simply there to try to persuade people not to take their benefit early. So it's just another variable that goes into your Social Security decision. Real quickly, one other factor that needs to probably be evaluated is going to be the taxation of your Social Security benefits. When will your Social Security benefit be taxable? And it's going to depend on this calculation of this thing that they call provisional income. This is something that the IRS has created that it uses for determining what portion, if any, of your Social Security benefit is taxable. And real simply what they do is they take your modified adjusted gross income off of your tax return, and they add in half of the Social Security benefits you receive within that year. Whatever that number is going to determine how much of your benefit is going to be taxed as ordinary income. So if your provisional income, let's say it's a married couple and you're filing jointly, is less than $32,000, your Social Security benefit is not taxable. If your provisional income is between $32,000 and $44,000, in most cases, 50% of your benefit is going to become taxable. And if you're above that $44,000 number, 85% of that benefit becomes taxable as ordinary income. So depending on what your anticipated income in retirement is going to be, especially what portion of that income is taxable, is really going to drive whether you have to pay taxes on your Social Security benefit. So one of the things that you may want to take a look at is, let's say you're an individual. Let's say you anticipate your provisional income is going to be $50,000 in a given year. There might be some strategies to try to lower your gross income, so that you don't have to pay as much in taxes. For example, you may have investments that are paying you dividends and capital gains. If you're not using that source of income as income, would it make more sense to maybe look at a tax-deferred investment that wouldn't create any sort of modified adjusted gross income and might still save you some taxes from a Social Security perspective? So real quickly, what I want to do is kind of take you through, kind of a comparison of a couple of strategies, just as a way to think about this Social Security decision. So we have a married couple here. They're both are currently age 62, and we're just going to assume that they're going to live to age 85. And we kind of put three different strategies as the most common strategies they could do. They could both collect right at age 62. They could both wait till their full retirement age of 66, or they could both collect at the age of 70. What we're also going to do is we're going to throw in a hybrid strategy, which I will talk about as well as a possible strategy to take a look at this. So here's real simple. We have Rob and Mary. If both of them waited to their full retirement age of 66, Rob's Social Security benefit would be $2,000 per month. Mary's would be $500 per month. So first strategy we take a look at, Rob collects the first day he's eligible, gets $1,500 per month. Mary's going to get $375 off of her $500 number because they're both subject to this 25% reduction because they're collecting early. And then Mary's also entitled to collect a spousal benefit off of Rob's work history, which brings their total Social Security benefit on a monthly basis to $2,225. Now, if they waited to age 66, Rob's benefit, he gets the full $2,000, Mary gets the full $500, and then she's entitled to an additional $500 in the form of a spousal benefit. Total benefit of $3,000 per month. If we have both of them wait to the age of 70, you'll see Rob gets those 8% delayed retirement credits. His benefit goes up to $2,640. Mary gets those delayed retirement credits. Her benefit goes up to $660. And then Mary's going to get an additional $340 to bring her benefit, her total benefit, to be half of what Rob's benefit would have been at full retirement age, and you get $3,640. So, and then the hybrid example says we're going to have Rob wait until he's 70, take full advantage of those delayed retirement credits. But we're going to have Mary collect right at 62. And when Mary collects right at 62 and she's eligible for a spousal benefit, that brings the total benefit to $3,365. Now, obviously, the factor here is you're going to collect the first two strategies for a longer period of time than you would for age 70. If we kind of use that average life expectancy taken into about age 85, here's what the strategies eventually total up to. What I want you to really pay attention to is, to me, the game changer strategies is if we can just get Rob and Mary to collect at age 65, we go from total Social Security benefit of $879 to over $1 million, right? So that's about $140,000 in total incremental income by just getting them to 62 to 66. If we can just get them to full retirement age, we get to a really good place in the Social Security benefit. You'll notice when you start balancing, collecting at 66 versus collecting at 70, I mean, the total change in income is about, let's call it $25,000 from that over a 20+ year life expectancy. It's more, but it's not what I would call game changer more from those different strategies. So hopefully what you take away here is there's a huge benefit if we can just get you to, full retirement age. And obviously this is built on them living to an age of 85. But just something to think about when you look at these different strategies. And one of the things why I always come back to this, why it's so important to work for a financial professional or work with a financial professional that will help you develop a detailed plan, is they can run scenarios just like this for you to see what strategy makes the most sense in your specific situation. So kind of next steps on Social Security, obviously understanding the rules, recognize the options and benefits available, and work with your finance professional to make the best decision for your specific retirement plan situation. So I know we spent a lot of time on Social Security. I just want to quickly go through, Medicare, and what are some of the things that you should be thinking about as it relates to healthcare costs in retirement. And there has been a lot written, and rightfully so, about what we're calling the retirement healthcare cost crisis. The stats that we continue to see, 10,000 people a day turning 65, we're seeing that only 27% of current workers have actually estimated the cost of healthcare in retirement, and 53% said it's important to discuss this cost, moving forward. To me, one of the most important factors, I think, in understanding what your healthcare costs are going to look like is the fact, I think the biggest misconception that people have as they approach retirement is they think that Medicare is just going to cover all the same things that my workplace health insurance program used to provide. So for example, I work for Equitable. My health insurance is through Aetna. So one of the analysis I did was I said, I wonder, when you're working, what percentage of your healthcare costs does your health insurance cover? And so I went and looked at some different statistics, and probably the most accurate one that I saw was a study from Kaiser Permanente, which said if you were a single individual and you were looking at your healthcare costs, your health insurance on average covers somewhere around 77% of your healthcare costs while you're working. And then I said, well, I wonder what the number is for Medicare. And when I did the study, which was back in 2018, basically Medicare came out and said that Medicare is designed to cover 51% of a retiree's healthcare costs in retirement, with that retiree essentially being responsible for 49% of that cost. So one of the challenges is that if you're comparing this to your current health insurance, Medicare is designed to cover significantly less, and I would argue the healthcare costs when you're retired will be more than what they were when you were working. And there's been a lot of studies within the industry that take a look at this. The one that I think has been around the longest, that I continually refer back to, is this Fidelity Benefits Consulting study. They've been doing this study since 2002. And what Fidelity does is they estimate that if you had a 65-year-old couple, so husband and wife, both age 65 today, over the next 20 years, taking them out to age 85, if you added up all of the out-of-pocket costs that were not covered by Medicare and added that up over a 20-year time period, it would total $285,000. Now, they make some assumptions for inflation of healthcare expenses, et cetera, but that kind of gives you a baseline of what you're going to be paying or potentially paying out of pocket for your healthcare costs. So where is that money going to come from? We also put a report that was done by a company called Health Use Services. They actually believe costs are going to inflate significantly more than Fidelity does. So that's why for the same study, their number comes in about $100,000 more. And I think one of the big drivers is, and we talked about it for Social Security, but here it is for Medicare as well, is that the longer you live, the more you're going to be reliant on, or the more costs you're going to have, related to the health expenses. So we went through this on the Social Security side. Obviously, the longer you live, the more money you're going to need for those out-of-pocket healthcare costs in retirement. And one of the big factors, and I think the thing that keeps a lot of people up at night, and rightfully so, is the fact that healthcare costs have actually been inflating at a much rapidly paced as compared to regular inflation. So when you look at the expected inflation rate in 2020, based off of CPI, is about 2.7%. The expected inflation rate for healthcare expenses is more than double that at 6%. And obviously, this is going to be a big factor of what healthcare costs are going to be, 3 years from now, 5 years from now, 10 years from now, and so on. So real quickly, I just want to kind of go over the basics of Medicare. Medicare's got a couple of different components to it. So your Part A, your Medicare Part A is what's often referred to as your hospital coverage. Think of expenses that you would incur as related to going into a hospital. What happens with your Part A coverage is the first cost that you have is you have a deductible of $1,400 or $1,408. And then it's going to look at the length of your hospital stay, moving forward. For most people in a given year, they're going to stay between that 1 and 60-day hospital stay. So they won't have any sort of co-insurance, but they obviously have that deductible that they need to meet first. Then your Part B is what I call your medical, your doctor coverage. Think of any expenses related to going to see a doctor. Part B is a little bit different in that Part B has a premium as well as kind of a cost share. And one of the things that they do on the premium side is your premiums can potentially increase if you're considered higher income. So for example, the base premium in 2020 is $144.60 per month. So everybody's going to pay that for their Part B coverage. But those individuals that have incomes above the thresholds could see those Part B premiums go up rather dramatically, depending on how high their income is going to be or how high their income was actually 2 years ago for what they based the calculation off of. Part B, when you start talking about the enrollment decision, a lot of people will enroll in Medicare around the month that they turn 65. You can actually start to enroll as early as 3 months prior, and then you also have the 3 months past your birthday. A really important factor is this special enrollment period, that if you're still working past the age of 65 and you still have health insurance through your employer, you can basically delay this enrollment decision up to 8 months from when your actual employment is going to end. So what you do is when you combine Part A and Part B, which is basically your hospital insurance and your doctor insurance, that's what they call original Medicare. And that's one of the ways that you can basically make the Medicare insurance decision. The other way is what are called Medicare Advantage plans, or Part C. These are plans that are offered by private insurance companies that work within the framework of Medicare. They will replace your Part A and your Part B, and you will get that coverage within a specific plan. You still pay your Part B premium every month, and then you will also have an incremental premium for the Advantage plan versus traditional Medicare. You may ask yourselves, why would somebody do these? Typically, there's a couple of reasons. One main reason is they may offer extra coverage for such things as vision, hearing, dental, and health and wellness that you find valuable that you won't see in your traditional, Medicare from that perspective. So it generally comes down to, is the incremental cost worth it in relation to the extra services that you might be getting from your Medicare Advantage plan? On average, what you'll see, here, I know I live here in the state of New Jersey. Looking at this statistic, it would tell you that about 21% of Medicare beneficiaries are enrolling in the Medicare Advantage plan, meaning that 79% are going with traditional Medicare. The national average as of 2017 was about 33%. And you do have the option on a given year to essentially flip from one to the other. You could be in original Medicare and then decide the next year that you want to try out a Medicare Part C or Medicare Advantage plan, or go vice versa from that perspective. Part D is your prescription drug coverage. So if you do original Medicare, which is your Part A and your Part B, Part D will give you your prescription drug coverage. Looks a lot like Part B in the fact that you will have a monthly premium, a yearly deductible, as well as it relates from that. So obviously a very important coverage to have. If you're going to do a Medicare Advantage plan, you'll want to pick a plan that has prescription drug coverage. Not all of them do, but a lot of the plans will have prescription drug coverage built into their plan. And here's just kind of that similar chart showing that if you are a higher income individual, your premiums could be increased, due to your higher income levels moving forward. And this is an important thing to kind of take a look at. And lastly, you have what's called Medigap or Medicare Supplemental Insurance. This is if you're doing what I call the original Medicare. So you do Part A, you do Part B, and you do Part D for your prescription drug coverage. You can also buy a supplemental insurance plan called the Medigap Policy. Each state typically will offer 10 different policies that's categorized by a letter in the alphabet. So at the end of the day, the Medigap decision usually is, do you want to pay for the supplemental insurance to cover many of the out-of-pocket expenses that Medicare doesn't cover, or do you want to just pay those along the way? It is important to note that a Medigap policy only covers one person. So if I was looking to get Medigap policies for my wife and I as we retire, I would need a Medigap policy. My wife would need a separate Medigap policy from that perspective. So here's just kind of a chart that shows some of the different Medigap policies. You will notice that we highlighted the F plan right there in the middle. About almost 2/3 of all the people who are doing a Medigap policy have chosen to do the F plan. Ironically, the F plan has been phased out, primarily replaced by the G plan, which looks very similar, to the F plan. But it always comes down to the more things it covers, the higher the premium is going to be. How valuable are those different benefits to you, and what are you willing to potentially pay for? So when you look at your Medicare coverage choice, you basically have a pretty simple decision tree, right? The decision comes down to, how do you want to get your coverage? Do you want to go with original Medicare, or do you want to go with the Medicare Advantage plan? If you choose original Medicare, Part A is going to cover your hospital insurance, Part B covers your medical insurance, and then the second very important step is you most likely want to add Part D, which is your prescription drug coverage. And then finally, the last step is, do you want to add a supplement policy or a Medigap policy to your Medicare coverage? If you elect to go the Medicare Advantage plan, like an HMO or a PPO, it's going to combine Part A and Part B. You pay your Part B premium, you pay that incremental premium for the plan, and then you'll want to select a plan that has prescription drug coverage to kind of combine all of them within one plan. And you can't even buy a Medigap policy if you wanted to, so that's pretty much the one decision there. The last thing I wanted to leave you on, just to kind of think about Medicare, is, I know when you hear those 285 or 389,000 numbers, they sound very daunting. So what I thought I would do is we use a company called HealthView to kind of estimate some Medicare costs. So let's just look at potential costs might be on an annual basis for an individual reaching the age of 65. So the first thing would be hospital copays and Medigap premiums. This is assuming that somebody is going to want to use a Medigap type of policy to cover, and this is assuming somebody did the original Medicare calculation. So what I factored in this example is we didn't anticipate any sort of hospital stay. So $1,600 really just covers your Medigap coverage. Your Part B coverage, which is your doctor coverage, this is the $144 per month, plus a few average co-pays coming out. That comes out to $1,600 per year. And then we have your prescription drug coverage. You're paying on average between $35 and $40 a month just for your prescription drug insurance. Then the first $450 or so is going to be your deductible. And then you have your prescription costs on top of that, moving forward, because once you get into the insurance zone, basically Medicare is going to cover 75% of your prescription drug costs. You're going to be responsible for 25%. And then lastly, assuming that you would get some sort of dental insurance, as well as hearing and vision. Now, we could probably debate maybe some of these costs you wouldn't necessarily think about that you would need, but just using this as a baseline example, this is a pretty normal year for a 65-year-old as it relates to Medicare services that they're going to need. If you add these all up, it basically comes out to about $6,000. This included no hospital stays, and I would say includes no what I would call extraordinary, medical events, for the individual. So if this was a married couple, we would probably say, if you think these costs are pretty accurate or relatable to you, then you basically would have out-of-pocket costs of $6,000 for you and $6,000 for your spouse. a total of $12,000 in a given year. You spread that out over 20 years with some sort of inflation. That's how you get to the $280,000 to $300,000 type of number. So what we truly advocate when you're doing the retirement planning process, and why it's so important to sit down with a financial professional, is we believe that your out-of-pocket healthcare expenses should be looked at as an essential expense. Just like your housing payment, just like money for food, clothing, shelter, that should all kind of go into that example. And we are a true believer of that you should be using reliable or guaranteed income sources to cover those essential expenses. And those guaranteed income sources are typically going to be your pension, your Social Security, annuities, maybe fixed income that you have. But that's an important process. I think if we can understand or start thinking about what I'm going to have to pay out of pocket for Medicare as an essential expense, I think you can build a better plan, with that moving forward. So that's pretty much the end. I know we went through a lot of information. What I really wanted to do was just kind of give you some different factors or things to be thinking about as it relates to Social Security and Medicare. I think if I had to summarize, the two is, if I think from a Social Security perspective, if we can build a strategy that at least gets you to wait to your full retirement age, I think you're going to come really close to maximizing your benefits. If you have a financial plan that allows you to take advantage of those delayed retirement credits up to the age of 70, then that's going to even further enhance the amount of money you'll get out of Social Security. But as a minimum, try to develop a plan that gets you to wait until you and your spouse are both age 66 or whatever your full retirement age is going to be. And then I think when you start looking at healthcare expenses, if we can think about out-of-pocket healthcare expenses as an essential expense, we can build an income plan to be able to address those different expenses. I know we went through rather quickly, the differences between Part A and Part B and Part D, and that can be confusing, and that's why we're here to work with you to provide you with much information, as possible as it relates to that. So with that, I'll turn it back over, turn the presentation back over, and if there are any questions, I'd be more than happy to address any of those moving forward.
Hey, Laird, it's John Lewandowski. We had a couple of questions come up while
Sure.
we were presenting. So the first was, do we expect that we'll see an increase in the full retirement age from age 68 to 70 at any point?
Yeah, that's a great question. I think one of the things which we've probably heard a lot of is, I guess what I call would be the financial solvency of the Social Security system. And the reality is that with Social Security, they're paying out more in benefits than they're collecting in the form of Social Security taxes. And there's been published data that somewhere in like the 2035 range, we would basically reach an impasse where we would basically be paying out so much more in benefits that there would be no money left in the Social Security system. So they have been contemplating some different changes. Now, one thing I want to make crystal clear is that even if the Social Security, let's call it the Social Security bank account, went all the way down to zero, the money that gets collected on an annual basis in the form of payroll taxes is enough to cover 75% of all the calculated Social Security benefits in perpetuity. It's somewhere between 75 and 80%. So any change that they want to do is obviously, how do we get that from 80 to 100%? One of the things they have contemplated is pushing back the retirement age. The original retirement age with Social Security was 65. So they've done it before. I don't necessarily think that it's necessarily going to happen again, simply because there is about 50% of people who are receiving Social Security. It represents their only income source in retirement. Hopefully all you individuals who get the pleasure of working with Colin, who are saving for retirement, won't be faced with that dynamic, but that's the reality of the Social Security system. So I have a tough time believing that they'll push the age back because of that. I think there's just too many people in their mid to late 60s that this is the only source of income in retirement that they have.
Awesome, thank you. So, while you were speaking, we did actually get just another question, and I'll just take
Sure.
this one. So, the question was, do you have to save up for out-of-pocket expenses for healthcare after retirement? And then also, what do you do if you don't have a pension? So it's actually great to have our partners on from Equitable, right? I mean, one of the products, one of the services that we can offer to our clients are, annuities with lifetime income riders, right? So in a situation for a client that maybe doesn't have a pension and doesn't have guaranteed income above and beyond Social Security through retirement, that's one of the strategies that we would absolutely look to use in order to, meet the gap in income that they're going to have, for expenses later on. So, again, that's something that we use our partners like Equitable and with some of the products and services that they offer to help plan for that in the future. And, the answer is yes, absolutely. While we're working, those are things that we save up for in order to fund, so that later on we know that we have income that will be able to sustain us through retirement. So, at this point, I don't see any other questions coming in. So I wanted to say thanks again to Laird, and thanks again very, very much to the Greater Alliance for giving us the opportunity to speak with everyone today. And, thanks everyone for your time. We will absolutely be sending a follow-up email with our contact information. I know there was a lot of really, really great information that Laird shared with us today. So we'd love for you guys to leverage us, reach out with any additional questions that you might have, and absolutely reach out so we can start working on, a plan for you guys and, setting you up for, your own personal situation as we get closer to retirement.
Thank you. No, thank you, Greater Alliance. Thank you, Laird. Thank you, Brian. If you have any questions, like John said, we'll send out an email. Please feel free to reach out to us. We're happy to do complimentary financial planning for all of our clients and everyone that are members at the Greater Alliance. Thank you, everybody. Send us an email if you have questions, and we'll send you some contact information as well.
Have a great day.